The silver bullet trading strategy stands out as a top-tier smart money setup, integrating the principles of liquidity sweep, market structure shift, and fair value gap entries. That said, it can become overwhelming when incorporating elements like market session timings, entry windows, and specific entry models into the approach. So here's what's on the agenda for today. We're going to walk you through a step-by-step breakdown on how to apply this trading setup across any chart, including all the mechanical rules that must be followed. On top of that, we'll offer some actionable insights to help boost the effectiveness of this strategy, all based on thorough backtesting results using the euro-dollar currency pair. If that sounds like something you're into, be sure to tap the like button to support the content and subscribe to the channel if you're tuning in for the first time. Catch you right after the intro and disclaimer. Before diving into this entry model, it's important to clarify that we rely on a specific time frame and time zone to identify trade opportunities within the silver bullet setup. This strategy is executed on the 5-minute chart, and the trading window runs from 9 p.m. New York time until the session ends. In simpler terms, we start scanning for setups about 90 minutes after the New York market opens and continue through to the close. Now, let's walk through how we set up our chart to examine market structure using the silver bullet strategy. Open any chart on tradingview.com and set the time frame to 5 minutes. Head over to the Indicators tab and search for Sessions. Select the one labeled Sessions on Chart by Oryx. This tool displays all market sessions, so we'll need to customize it. In the Settings menu, deselect both the Tokyo and London sessions, and adjust the New York session start time to 9:30. Next, activate the Period Separator feature on TradingView. Right-click anywhere on the chart, go to Settings, and under the Events tab, enable Session Breaks. This will add vertical lines that divide each trading day. The red box highlights the window when we'll search for entries, while the blue lines mark the boundaries between daily sessions. The blank area illustrates the London and Asian sessions. The high and low formed during these sessions play a critical role in the silver bullet method. We'll cover that in more detail shortly. So essentially, the initial step in the silver bullet strategy is to configure your chart and establish the defined trading window. The following step involves pinpointing a precise entry model for the setup. In this trading model, the chart first shows price breaking above the high of the day, triggering a liquidity sweep. This indicates that the market has targeted the liquidity resting above the key structure, the highest price reached during the Asian and London sessions. Following this, we see a bearish market structure shift, suggesting a potential downside reversal. This acts as a strong signal that the bullish momentum has ended, and sellers could now be taking control. At this stage, we focus on identifying a fair value gap zone, which serves as our ideal entry point for a short position. The logic behind this model is rooted in algorithmic price movement. Price is driven above the day's high to activate liquidity and trap long positions, after which smart money enters short to target the sell-side liquidity sitting beneath the day's low. We then witness a bearish breakout below the prior low, reinforcing the reversal setup. The fair value gaps that emerge after the structure shift are regarded as our supply zones for initiating a short trade. The same principle applies in a bearish setup. We want to see a break below the low of the day, followed by a bullish market structure shift. This signals that algorithmic price movement has cleared the liquidity resting below the key level, the day's lowest point, misleading traders who expected the downtrend to continue. After this sweep of sell-side liquidity, smart money shifts its focus toward buy-side liquidity, which is typically found around the high of the day. The final and most critical step is to pinpoint the fair value gap, which becomes our ideal zone for entering a long position. So basically, the second step of the silver bullet trading strategy has 3 milestones. First, wait for the price to engage the liquidity above the day's high or below the day's low. Second, identify a market structure shift to confirm the reversal. Third, identify the optimal trading zones, which are the fair value gap areas. Here is an important point: if even one of these criteria is unfulfilled, we won't take any trade. We simply wait for another trading day to implement the silver bullet trading strategy. Now we move on to the third and final step, which is executing the trade. As stated earlier, fair value gap zones serve as our prime areas for trade execution. So, we mark them on the chart and prepare to enter positions when the price retraces into these regions. For instance, in this setup, the most recent impulsive move started from this point and extended up to this level. Within this leg, we can identify 2 fair value gaps. The market often retraces to these zones to balance price inefficiencies, and once it does, these areas generally act as support, helping push price further upward. Now, here's a crucial detail. We are only focused on buying within the discount area and selling within the premium zone of the retracement range. To define this, we apply the Fibonacci retracement tool from the move's origin to its high. The space above the 50% mark is considered premium, and the area below it is labeled the discount zone. That's why our attention is on the lower fair value gap, for several reasons. Markets tend to hunt early buyers, so a safer entry method is to wait for price to dip into the discount. This approach improves trade reliability and minimizes the chance of falling victim to a liquidity sweep. Another key benefit is a better risk-to-reward ratio, which is vital. Here's how we plan our entry. We place a buy limit order at the start of the fair value gap, with our stop loss set below the first of the 3 candles that form the gap. To manage risk, we'll shift our stop to break even once price hits a 1 to 2 risk-to-reward level, closing half of our position. This ensures that if the market pulls back and tags our stop, we exit the trade at break even, avoiding any loss. This way, we can continue holding our position stress-free, allowing room for extended profit. For our second take-profit target, we can either aim for 2 to 3 times our risk or go for significant levels from higher time frames. The exact same methodology applies to bearish setups. Once we've spotted a fair value gap, we confirm it's located in the premium region of the retracement range. If it is, we set a sell limit at the beginning of the gap, place our stop above the candle that created it, and pursue the same trade targets as outlined in the bullish example. Now, let's review some backtesting data on the EUR/USD currency pair. What you're seeing here represents the most recent week of price action on this pair. As noted earlier, the red box highlights the specific time window during which we search for trading setups. This begins 90 minutes after the New York session kicks off. The first step we take is to mark the high and low of the trading day prior to the New York Open. In this instance, we can observe that the price pushed above the day's high, tapping into buy-side liquidity. Shortly after, the price re-entered the previous range. This type of movement is typically viewed as a liquidity sweep. However, a confirmed reversal requires a market structure shift. That confirmation comes here, where price breaks beneath the demand zone, indicating a bearish shift in momentum. This followed a series of minor bullish attempts. During this shift, several fair value gaps were created, which now serve as our supply zones for entering short positions. But when we apply the Fibonacci retracement tool, it becomes clear that only this specific gap falls within the premium zone of the range, making it the only one we're interested in trading. Let's move on to the following day. We have another ideal setup here. The market swept liquidity below the day's low and quickly returned back within the previous range. After a brief consolidation phase, price broke structure to the upside with an imbalance, leading to the formation of multiple fair value gaps. By measuring from the start to the end of this impulsive move using the Fibonacci retracement tool, we notice that only the lower gap falls within the discount zone. This defines our key demand area to consider long positions. The stop loss will be placed just below the fair value gap, as the zone is relatively wide, and targets will be set following our predefined strategy. Now looking at the next trading day, prior to the New York session, the market made a liquidity grab above a well-tested resistance level. Notice how often that level was challenged. If we interpret the break below this strong demand level as a shift in market structure, there was a solid opportunity to go short from this specific fair value gap zone. However, the price never pulled back into that region due to aggressive selling. While the bearish trend was still tradable, no fair value gap could be identified above the 50% retracement level, resulting in a missed trade. In this next section of the video, we're going to explore an alternative setup within the silver bullet model, closely resembling the initial one, but with a key distinction. It still involves the same sequence: a liquidity sweep, a market structure shift, and an imbalance formation. However, the primary difference here is that this liquidity grab occurs during the New York session itself. Despite this variation in timing, all the previously outlined rules for the setup remain completely applicable to this scenario as well. On the Euro-Dollar 5-minute chart, we can identify the low and high of the day formed during the Asian and London sessions. Even though the price didn't breach these significant liquidity zones, we need to shift our focus toward the activity occurring within our defined trading hours. We can spot the silver bullet trading model. The price has taken out liquidity above the highest point formed during the New York session. A market structure shift has occurred, indicating a potential downside reversal. The most recent move has left behind a fair value gap, reflecting bearish momentum. Now, if this FVG is positioned within the premium zone of the retracement range, it becomes a valid area to consider a short entry. The core idea behind this setup remains unchanged, with the only variation being that price targets liquidity above the latest structure specifically formed in the New York session. Keep in mind that sometimes fair value gaps align exactly with the 50% retracement level. So, how do we handle entries in this case? We only consider the part of the FVG that lies within the discount zone as our optimal trade area. We set our entry around the 50% level and apply our standard target strategy. However, since this gives us a narrow demand zone, it requires a wider stop loss for protection. This FVG zone is optimal for entering a buy trade. But remember, a perfect rejection from this box isn't a guarantee. The market might bypass this zone and reverse from lower levels. That's why when dealing with larger trading zones, we keep the stop loss tighter just below the zone. But for smaller zones, we place a slightly larger stop loss beneath the area. Always remember, live trading means real capital and real emotions. It's a whole different game compared to paper trading or demo accounts. Success comes from strict discipline and sticking to your trading plan, your ultimate blueprint. So traders, if you found value in this video, don't forget to like and help support our content. And if you're new here, hit that subscribe button. See you in the next episode.